Okay, wanted to do a very serious article, a deep dive. Um, this came to my inbox because Peak Bridge does their quarterly emails right on schedule, but this article is more than a month old, written back in May of 2024. But nonetheless, we will jump into it, we will read it, we will analyze it, and then we will give our feedback on what I think is a very well written piece, very informative from four folks that are represent Peakbridge. So let's just jump in and um, see what we can take from this article. So article begins, food tech is at a crucial tipping point. Um, and with tipping points comes opportunities, but the real potential of this space has gotten muddled, and it's a good time to cut through the noise. A fair amount of hype and non-expert takes have painted a picture of a new, entirely high-risk sector defined solely by alternative proteins. None of that is quite right, and reality is in fact rosier, particularly for forward-thinking investors. Let's rewind for a moment. Food is a $9 trillion industry that quite literally touches every one of us every day. Innovation in the sector has been ongoing for decades, helping give rise to multi-billion dollar CPGs, consumer packaged goods, and specialty ingredient players. Alongside that has been growth in deal making, with nearly all major private equity houses investing without high CapEx or particularly high risk. Then, in the past 5 to 10 years, came an upheaval and a world of possibility. Advanced tech from information technology, sensors, satellite data, and robotics, and biotech, CRISPR, precision fermentation, and cell culture entered the game, turning food tech into what it is today, a serious, scalable VC play. AI will take it further faster. Add to that a global shift in consumer behavior, with growing demand for health-conscious, sustainable food options, as well as growing urgency to address food security and climate change, which by now has resulted in governments spending billions to mitigate these existential risks. Now the time has come to make the leap forward. Many worthy food tech companies have already done their core R&D and jumped through the regulatory hoops. The next 1 to 3 years are a crucial time frame to move out of the lab and into the real world. And with the right approach, that doesn't require high risk or high capital, even in today's inflationary environment. The upside for investors is substantial, and it's not centered around IPOs. Instead, mergers and acquisitions and exits via trade sales to strategics are the more likely path, thanks to the massive global food industry. Food corporates spend just 0.4% of their revenue on research and development, compared to software at 18% and pharma at 12%. In absolute numbers, the top 10 food and food ingredient companies spend just $4 to $5 billion per year on research and development, and an average of $22 billion a year on mergers and acquisitions. Corporates and their big name brands aren't built for risk or, frankly, for ground up innovation, but they can't afford not to innovate either. Their preferred path is to let someone else do the trial and error, scale, and buy them out, and that equals significant ROI potential. Debunking the myths. When we talk about scaling up food tech, the big barrier to cross is high capital expenditure. Scaling can often require boosting production volumes of ingredients and enabling technologies, which in turn demands equipment and sometimes entire greenfield facilities, along with the supply chains and specialized labor to operate them. While the last few years of branding hype have skewed the conversation, not all food tech requires sky-high CapEx. Food tech does not equal alternative proteins. This sector goes far beyond alternative proteins, though reading about it you might not be able to tell. Bulk, animal-free proteins often demand hundreds of millions in capex, but there's a wide range even within that space itself. Areas of high impact potential that require far less capex and risk. Take alternative dairy. Its production is better established and is based on key ingredients far less expensive to replace. Dairy is almost 90% water. The global plant-based milk market is expected to surpass $123 billion by 2030. For added perspective, in the Western world, alternative dairy makes up some 16% of the market compared to just 0.5% for alternative meats. The focus on innovation now needs to shift towards better taste and sustainability, like what Austria's Kerntech is doing with their plant-based milk derived from fruit seeds. Processing these readily available sources requires significantly less capital investment than the high upfront costs associated with novel feedstocks, which can range from specialized processing equipment to lengthy regulatory approvals. Reasons to look beyond just alternative proteins goes farther. We have a mounting dietary fiber gap. We waste 1/3 of our food across the supply chain, and we urgently must create more resilient production systems for food ingredients. All these areas have different business models, unit economics, and CapEx requirements, while sizably contributing to better food systems. Food tech is also about saving food. When looking for relatively low risk and high scaling potential, we should also be thinking not just about what new proteins and food to produce, but at how to save what we already make. One of the biggest and most expensive problems in the food system is the massive amount of food waste across the supply chain. 1.3 billion tons of food are wasted every year. Smart tech solutions integrating AI and imaging like Neolithics and Orbisk allow for scalability without a large investment in CapEx, IP, and regulation, since we're reducing things that have already been produced and exist in the market. New solutions, old tech. The message of disruptiveness gets thrown around a lot, but many companies are in fact deploying proven technologies where both technical and engineering risks have already been addressed in other industries. Take the Mediterranean Food Lab, a company reinventing food flavor. Their team found a clever new tech-driven approach to apply a centuries-old process used for making things we all regularly consume, like soy sauce, solid-state fermentation. Cases like these using validated tech don't face the same hurdles seen in spaces like cultivated meats. That means they're right for scaling without extraordinary capital expenditures. In short, more bang for your less buck. There's always a way. No matter the capital intensity of the business, investors and founders can and do find clever ways to mitigate them. Those include road mapping to identify when CapEx investments are truly needed to de-risk the next phase in go-to-market and attaining offtakes, or forging partnerships within the supply chain from farmers to industry partners. Take the Wageningen food tech startup Revi, which uses patented technology to produce protein and fiber ingredients from brewers' spent yeast. Their strategic partnership with leading agricultural cooperative Royal Cosun aims to scale up ingredients that can be used in a wide range of foods. For another approach, look no further than cell culture, where huge pushback has surrounded a lack of affordability. By targeting high-value species, companies can reach scale and unit economics, building a solid business case along the way. Doing so lays the foundation to then scale more broadly into lower-value species. A great example is VOW, using cultured meat technology to pioneer a new animal crafted from cultured Japanese quail, now on the market in Singapore. 4C chose cultivated eel as its first product, a highly priced and an endangered species. The key to getting it right, unit economics. In food and food tech alike, rigor around unit economics analysis is key. Scaling up a new process is crucial to proving unit economics and securing hard customer traction. The typical catch-22 mantra of "we need scale to serve customers, and without customers we can't raise financing to scale" is too simplistic. First, unit economics reveals true technological innovation and competitive advantage. Gross margin makes the difference between temporal and sustainable revenue growth. Growing a food tech business with positive unit economics means a company has found and proven a way to translate technology into a cost and/or a market share advantage. It's hard to escape the required operational expenses to scale a business, and legacy players will often hold scale advantage around such expenses. Above expected gross margins are a sign of a true sustainable advantage. Second, kicking the can down the road just doesn't work. Yes, economies of scale matter, but achieving critical technological metrics is key to getting it right before raising hundreds of millions in funding to scale capacity. This requires businesses to carefully consider which product-market combination to target. Climate-controlled indoor agriculture economics are more favorable to, say, vanilla than lettuce. Like Vanilla Vida demonstrates, it also requires detailed and honest assessment of scale-up pathways, proving feedstock efficacy, unit operations and yields, i.e., critical drivers of many cost of goods structures, at more modest volume increases. For example, through co-manufacturing partners, allows founders to de-risk their process and unit economics ahead of those mega rounds for big capex projects. Here too, we need to look at the broader food tech picture to identify those companies with proven positive unit economics in their current scale of production. A stage set for deals. The last 5 years have seen a rich deal-making environment growing steadily with healthy returns in private equity and strategic mergers and acquisitions. Funding has flowed into the space to scale up innovative startups, coming from early moving institutional money, emerging specialized investors, sovereign funds like Temasek, GCC, and sovereign wealth funds, and select food corporates willing to finance heavier capex for a bigger payoff like JBS, Tyson, and ADM. To understand just how resilient the deal-making environment is, look no further than ingredient companies, where investments and exits across maturities have been steadily growing over the last 7 years. They've shown remarkable resilience, emerging relatively unscathed through a pandemic and conflict. Strategics have record levels of cash on their balance sheets and free cash flow built up on the back of strong financial results. They're also quickly pivoting to meet consumer preferences, investing in natural and clean label products. As Morgan Stanley noted in their January 2024 report, innovations for large ingredient strategics in 2024 are situated in the bio-based sustainable nutrition/solutions and health and wellness space, thereby supporting fast-moving consumer goods, sustainability commitments, and regulatory requirements, and we expect those consumers to step up innovation/product launch mode. Okay, so Sensient, Symrise, Givaudan, and Ingredion are among those who have ramped up investments in plants and other facilities, with IFF, DSM, Huber, and many more among those closing mergers and acquisitions to fill portfolio gaps. Others are also increasing their exposure to the plant-based space, aiming to develop the next generation of products with better taste and texture. ADM Cargill and Bunge have spent hundreds of millions on production and processing facilities. Others are leveraging mergers and acquisitions to add new capabilities, with further consolidation of plant-based ingredients expected. Okay, food ingredients have also drawn greater focus in private equity, with many new platform investments seeking bolt-on acquisitions and boasting a record $2.6 trillion in dry powder as of 2023. What is likely to change? The types of acquisitions. Value creation from large-scale deals is somewhat limited and affected by interest rate hikes, so it's small to mid-sized strategic acquisitions that are expected to gain more focus in 2024-2025 and have historically proven more beneficial. Closing the gap. Yes, there is still a funding gap, and filling it is essential to pushing the right companies to the next level of getting to price parity, so that nice-to-have technology can become a scalable solution with global impact. Generalist investors can play a significant role in making that happen, yet they often aren't inclined to focus on food tech given the field's fast-moving developments and technical complexities with less familiar risks that are therefore harder to manage. Yet generalist funds simply don't need to master the space on their own. Instead, clever strategic partnerships with sector experts can unpack the different layers of perceived risk from commercialization to scaling up production. Take, for example, food ingredients like fungal proteins. Those might not have been produced at scale in the past, but their production technologies and required infrastructure have seen large-scale validation in adjacent industries. Once those scale-up risks are better understood and technical milestones achieved, financing a scale-up operation becomes an assessment of market risk more than technical or production risks. When it comes to commercialization, smart commercial partnerships can similarly clarify the associated risks, along with the true potential for attractive returns on such investments. Bigger picture, what's the takeaway? Food tech's time has come to make that leap forward, and cutting through the noise reveals a different reality than most have come to believe. A veteran industry powered by information technology, biotech, and AI, bold companies ripe for scaling, and a global environment that demands nothing less. An emerging asset class with substantial opportunity. With the right guidance and expertise, we can bring tech to bear and make returns in one of the biggest global markets in existence, food. End of article. Okay, so that was really an outstanding article. So tip of the hat to the co-authors, Mr. Ben, Mr. Den Bozem, Mr. El Kazen, and Mr. Glickman. So the key takeaway, and I think what the authors were trying to tie at the end was that if there are general investors, because back in 2020 and 2021, during the peak of the last sort of investment cycle, before the last few years that really slowed down, was that one of the critiques that I've been hearing and reading about was Generalist investors came in, they were inexperienced, they had unreal expectations, they lacked the expertise, they weren't synergistic, and they ended up being very snake bit, and it left a bad taste in their mouth, pun intended, for the industry overall. So the authors of this article are basically saying that with biotech, with AI, with all of these key developments that are taking place, yeah, IT in general, uh, there's it's the right place and right time for generalist investors to dip their toes back into the marketplace because a lot of things are coming to a head. And then, of course, which is really my fundraising and investment thesis, which I've said in many videos already to date, is what has been addressed here is that you can just sort of, if you've been in the industry long enough, you can just feel that M&As and the gobbling up of smaller food startups or brands by the larger companies, whether they're private or public, is really the name of the game. So the key statistic that was listed in this article was the R&D. Um, right. So the research and development, it says here, yeah, it's that, for example, it says food corporates spend just 0.4% of their revenue on R&D, compared to a software company spends 18% on R&D, and a pharma company spends 12% on R&D. So in absolute numbers, the top 10 food and food ingredient companies spend just 4 to 5 billion a year on R&D, and yet an average of 22 billion on M&A. So that we're talking about the biggest of the biggest brands, according to these authors. So those are the key points that I took away, which sort of validates and affirms my belief that um, the startups, the brands, those people that have created a beachhead, that have a sort of established a small market, the way that they want to really either dilute their equity or to get the next round of funding or to find a synergistic partner is to be dealing with the larger players. And it seems that some of the niche and the gap that we try to fill is just this, which is canvassing and connecting the two sides. So, having said that, very interesting article. There was a bit of self-promotion throughout the article because the authors talked about some of their portfolio companies, um, namely, I guess, Kerntech, Neolithics, Orbisk, the Mediterranean Food Lab, Revi, Vow, Vanilla Vita. Um, that's the majority of them. But look, it was a great read. Some great graphs are also included in the article that just talk about dry powder, global private equity, dry powder in general. And yeah, this information that was provided by PitchBook, talking about food mergers and acquisitions and ingredient company mergers and acquisitions, um, free cash flow, cash and equity on balance sheet, unprecedented pieces of information, and it's all coming together. So I think the authors are spot on. Have written a great article, and hopefully their LPs and all of the partners that they're working with are also on the same page per se, understanding that these next few years is a way to truly achieve unprecedented and really disproportionate returns, assuming that there's a meeting of the minds and that there is aligned interest in the companies that they're investing into. Okay, um, very good article nonetheless. Great read.